But we'll do some quick introductions. I'm Matthew Burke. I'm one of the partners here at Cerini and Associates who works in our nonprofit practice area. With me today is Tanya Quigley, who's also a partner in Cerini and Associates nonprofit practice area. We have a presentation planned for you here today to really help educate board members about financial accountability. This is the agenda. So really, we're focusing on the Form 990, which is the IRS tax filing that has to go for every nonprofit. And that becomes a public inspection document. So board members really should understand that. So we have some topics on that. Board meeting minutes is something we want to talk about too. As auditors, which is what we do most of our lives, we have the privilege and challenge sometimes of reviewing board meeting minutes as part of our audits. So we definitely have some feedback to provide there. Tanya will be talking through those few first topics. I'll take it from there and talk about financial reports, metrics, trends, how to read financial statements, what kind of questions you should be asking, and then get a little bit into budgeting and some other board engagement topics for financial accountability and risk management. So share any questions in the chat. We'll try to answer. Tanya and I will alternate so we have some time to answer Q&A. So with that, Tanya, you can take it away.
Thanks, Matt. So as a board member, you have a responsibility for reviewing the 990, having a pretty good understanding of it so that you can ask questions, comment if something doesn't seem correct, or just want further clarification for how things are presented on your 990. This is, like Matt said, it's a public document. It's out there for the world to see. You want to make sure it's 100% accurate. So we'll just go through certain parts of the 990 that are more focused on what the public also focuses on. So just have a general understanding of what to look for and what each part represents. So part one is a summary, the first page of the 990. It very importantly has your mission as the first item there. So making sure that when you get this 990 for review, you're looking at your mission statement. Is it correct? Is it clear? Does it match what's on your website? Making sure that that is updated and most reflective of the mission. You also have a snapshot of your financial information, your revenue, expenses, your assets and liabilities and net assets, and it's comparable year over year. So it's a general sense of, how operations were, this year compared to last year. So it's a good way to compare the two, identify anything that may seem off or, noticeable trend between year over year. And if the organization has financial statements, reviewed or audited, those numbers should be, kind of tie into your financials. There's some quirks here and there about what's reported on the 990 versus the financials, but in general, those items should match. Part three, this is a very important page of the form because it outlines all the accomplishments that the organization has made during the year with your major programs. So the more information on here, the better. It really gives the opportunity for the organization to, explain the accomplishments that were done in each of your major programs. So making sure that this information is reflective of what happened during the current year instead of just carrying forward year over year. Include any statistics, how many people you served, food provided, animals adopted. The more information to show an impact, the better. This is definitely something that, donors look at, grantors look at to see what the organization has done for that year. To get help with writing, talk to your development person to kind of get that information in there. But again, as a board member, look at this, make sure it's accurate, it's reflective of the organization. And then another important piece of this is your allocation of program expenses. So each program listed here gets an allocation of expenses, making sure it seems reasonable that most of your expenses for a program are relating to your more significant programs, and getting an understanding of how those costs are allocated as well. So that's good practice to have. So part five is your tax compliance. We did skip one part of the 990. It's a bunch of yes and no compliance, yes, no questions relating to the supplemental schedules that we'll get to towards the end of the 990 slides. But right now, your tax compliance. So, for 501c3 organizations, not all these questions apply, but it gives a general sense of, it reports the organization's number of employees. Do you file your payroll tax returns? Do you issue any 1099s? Are you compliant with those annual filings? you know, and making sure that you're reporting your employees properly on this form as opposed to, you know, a part of your 1099 issued. The other tax compliance questions relate to donor receipts. So the organizations, you know, are you giving your donors letters explaining that this portion of your donation is tax deductible, and what was the value of the goods or services received for your donation? And typically this comes in through fundraising events. So if the organization, you know, for people that give like sponsorships, purchase tickets, you know, a portion of that is typically a donation, and the organization should be, you know, issuing those letters. Other items on this list, on this page, is, you know, did the organization have unrelated business income, or do you have any foreign bank and financial accounts? You know, so those two items that are not, they may not be very common, but they are put on this page here to make sure that the organization is filing the appropriate supplemental tax forms for those items that apply to that. Part 6 is your governance. It has, you know, the policies that are in place at the organization. It's important to make sure that these policies that apply to the organization are effectively in place, and the 990 also requires an explanation for certain policies that are in place. So does the organization have a conflict of interest policy, whistleblower policy, document retention policy? So all those questions are on this form. And another important policy is how they determine officer compensation. And that usually requires an explanation in Schedule O. Schedule O also explains, you know, how the conflict of interest policy is followed. As I said in the beginning, it's important that the board reviews the 990 before it gets filed, and that is one of the questions on this page. You know, does the organization provide a copy of the 990 to the board for review prior to being filed? And that is encouraged to be yes. And then in Schedule O, it explains the process. So making sure, you know, as a board member reviewing these policies, are they in place? Are they properly explained in Schedule O is important. Another important thing is at the end of this form, it explains how the organization discloses the 990 and financials to the public. So the 990 gives, you know, the greater transparency the organization has, the better. So having those responses to be like, yes, we make our documents available. The 990 is on our website. So a good way an easy way to make sure that you're as transparent as possible with the 990 is just post it on the website. And then the organization, you know, anyone can go to your website to see that. And you can mark that question yes on the 990. Compensation, another common form page of the 990 that's looked at by donors, grantors. You know, they want to see how large the board is of an organization, the officers, how much are being compensated. So it's important to make sure that you have an understanding of how employees are classified, what their compensation is their compensation reasonable compared to the organization size, is the compensation policies being followed for how those executive compensation is being set each year. And it doesn't just include your W-2 wages, it includes, you know, if you have any bonuses, retirement plan contributions, health benefits, any kind of benefits that the organization pays on behalf of the executives gets reported here. Another, you know, useful tool of this page is that organizations can use it to help set their own executive compensation. So this being a public document, you can easily search this on GuideStar, IRS website, just to see, you know, get organizations that are comparable to yours, see what their officers' compensations are, and use that as kind of a guide to set your own officer compensation salary. So again, this is something that is important to understand and that it's reported correctly for your officer comp and your list of board members. Your statement of revenue. So this is a snapshot of the organization's sources of income, whether it's, you know, contributions, program service revenue, fundraising events, you know, sale of inventory. So this, you know, again, as a board member looking at this page, you know, you want to the more sources of income, the better. So again, it's a good way to see like overall, are we too highly dependent on just contributions into the organization? Are we too dependent on a certain fundraising event that's bringing in most of our revenue? So again, comparing this to your statement of activities to make sure that the information is presented correctly, and then also evaluating if maybe the organization needs to expand its sources of revenue to through other means, government grants. So again, it's something that the board members should really take a look at to see how the organization resulted in operations through your different revenue sources. Your statement of functional expenses. So this, again, as a nonprofit, you allocate your costs between on a functional basis and a classification basis. So what you spent your costs on, compensation, payroll, professional fees, and then the columns here have your costs based on program management, general, and fundraising. Again, this is also another page that's really focused on to see how much costs overall that the organization spends on its programs, as most of it should be, because that's your programs running the organization, serving its mission. So the organization should, as a board member, you should be able to see, how costs are being allocated. Does it make sense that most of your program costs, most of your types of expenses are for a program? So most of your salary should be towards program. Most of your operating costs should be towards program. And again, comparing this to your financial statements to also see that it's that's correctly reported here. Usually, we recommend at least 70% of your expenses being directly for program services, and the higher percentage, the better. Your balance sheet or your statement of financial position. This is still this is a comparable form, so current year and prior year. And again, this should mirror what's on your financial statements. And it's a good way to look at how the organization's assets versus liabilities are. Again, you want to have, look at your different ratios to see your asset to debt ratio. Does the organization look like it has, sufficient cash, investments, to fund the organization to make sure that they can pay its accounts payable, its loans. So again, getting an overall view of how the organization's solvency is, does the organization look like it's going to, continue strong into the next year, or do certain things need to be adjusted for in the next year as far as, increasing your investment portfolio, building some reserves. So this is a good snapshot of that. And then also for your net asset, it lists out your your net assets with donor restrictions and net assets without donor restrictions. So this last page of the 990 is your financial reporting. I mean, it has the top of your reconciliation of net assets, but the last part here is important to understand, did the organization have an audit or review? Those questions should be properly answered. Were you consolidated on a separate basis of your financial statements? So as a board member, making sure you understand, we had a review performed, making sure that we mark this question, yes, that the financials were compiled or reviewed. Another question here is if the organization was subject to uniform guidance, did that compliance audit take place? So making sure that question is marked properly. So just getting an understanding of the financial reporting requirements as it relates to how it's reported on the 990. So there's the 990, and then there's schedules that supplement the 990. And the schedules are determined based on, how you answer certain questions of the 990. There's a lot of schedules A through R. So I'll just kind of briefly go through some. The most common that nonprofits fill out is Schedule A. So that really gives you your public charity status, how much of your, where are your sources of revenue coming through. So as as a 501c3, as publicly supported, it's expected that most of your revenue should come from the general public and not so concentrated on a few donors. And Schedule A calculates that percentage of your revenue that's from, the general public. And it's a 5-year period, so the previous 4 years are included on there as well. Schedule B has your list of significant donors. So including, there's a certain threshold to making sure that information is correct. That is not open to public inspection. So when the organization does post its 990 on the website, it's important to exclude that Schedule B. If the organization had any lobbying activity, that would be covered under Schedule C. And then another common Schedule J, which further explains the employee compensation, executive compensation, if the executives make over a certain dollar amount. And so as a board member, to understand your compensation policy, because that is outlined in more detail on Schedule J. And then Schedule R is a common one. If you have any related entities, that information is included on Schedule R. For the transactions between the two entities, and making sure that as a board member, you want to understand the transactions between the two. Is it properly documented and identified on Schedule R? Schedule O is always going to be part of your 990. That is a catch-all. So anything on the 990 that needs further explanation is included on Schedule O. Your mission statement, your major program services, any of those explanations, if they don't all fit on the 990 page, they get carried over into Schedule O. So that's the additional schedules to supplement the 990. And it's good as a board member to understand what schedules need to be included so that, there's all those schedules are properly included in your IRS filing. If not, obviously there'll be correspondence from the IRS asking for certain schedules. So the importance of meeting minutes. So there's 2 slides that cover this. As a board member, everything that's discussed should be documented, in the meeting minutes. Typically, secretary takes these meeting minutes, and they're available for the next board meeting to review and approve. So again, the meeting minutes give an overall discussion, snapshot of what was discussed, any decisions that were made at the board level, anything like that concerns governing the organization is documented, and it's very important. It serves multiple purposes, and it protects the board. It protects, the organization as it shows that things were discussed as they should be. So legal and regulatory compliance. So it's the official records that demonstrate that the board is fulfilling their responsibility and adherence to governance requirements. As Matt mentioned before, the audit and financial oversight support. As auditors, we look at your board meeting minutes. So the information in those meeting minutes, it's essential that it's accurate, and because information that's discussed there, we incorporate into our audit, and it just serves as a piece of audit evidence. Transparency and accountability. Again, well-documented minutes promote trust among stakeholders, showing that decisions are made responsibly and with proper oversight. So whether it's, a decision for, expanding certain programs or deciding to do a certain fundraising event, whatever the case may be, that it's all well documented. Institutional and memory and continuity. So minutes are a historical record that keep current and future board members understand the past decisions and maintain strategic direction. Again, your minutes should be maintained in perpetuity. Always have a safe spot for them, whether it's electronic, always keep it electronic copy, but, if printed is fine as well. But those should always be maintained. Risk mitigation and legal protection. Accurate minutes can protect the organization and its board members in the event of any legal disputes or compliance investigations. As a board, you meet regularly, and the minutes, the discussions are in the meeting minutes. I mean, this also applies to other committees of the board, whether you have a finance committee, investment committee, compliance committee. Those meeting minutes should be maintained as well. And they all serve the same, the same purpose to document the board members and the committee discussions and decisions. Again, drilling in on the importance of your maintaining accurate and timely minutes. So verifying completeness and clarity. Ensure minutes include key elements such as date, time, the attendees, quorum status, motions, votes, and decisions. Written clearly and objectively. Use a consistent format. So if there's a standard template that should be used, it's done for every meeting minutes. So it promotes uniformity and makes it easier to review for auditors and for board members. So if there's certain, points of the meeting that are in a certain order, it's something that the board members are familiar with and they can easily read through and approve. Review and approve promptly, circulating draft minutes shortly after meetings and approve them at the next board meeting to maintain timely and accurate records. Again, making sure that as a board member, you receive these minutes well in advance of your next board meeting. This way it gives you time to review, identify if there's any corrections need to be made or, have any questions. So it's not like you're put on the spot, review last meeting's minutes and just make a motion to approve. So the sooner that those become available, the better to your board members. Document financial oversight actions, clearly record discussions and approvals relating to budgets, financial statements, audits, and risk management to demonstrate fiduciary responsibility. Again, this also includes the 990. So discussion, having that as the 990 circulated as within one of your board meetings. Again, that would be documented that you guys are meeting that fiduciary responsibility. Secure and organized records. So secure, as I said before, securing your minutes in a centralized location with proper access controls and backup procedures to ensure audit readiness, or if any meeting minutes need to be reviewed for whatever reason, whether it's litigation reasons or to support a decision that the board has made. So, filing them, in an organized way is important as a board. Yep. And recording board meeting minutes, that would be very helpful. That'll be easier to, take those minutes, whether you use, Copilot or any kind of AI to summarize those meeting minutes and just kind of clean through to clean up any discussions. So that's certainly acceptable. All right, Matt, you're up.
Okay, thank you, Tanya. So now I'm here to talk about financial statements. We as auditors usually present to boards of directors and or audit finance committees as part of our closing procedures in our audit. It's like the last thing you do usually. What we're seeing here is that board members don't often know exactly what they're looking at because they may not have finance backgrounds, but as Tanya mentioned, they're fiduciaries for the organization, so they have to understand something at least, and they need to at least digest and consume the information being provided to them and realistically be able to ask smart questions of management and know what's going on. So the goal now for me is to help explain what it is you're looking at when you see these financial statements, kind of benchmarking and metrics and trends and ratios and things like that you can use to really understand what's going on financially with the organization you're representing. I think is very important and definitely an underserved area that we see. So the key financial statements that affect nonprofits are similar to what they would be for for-profit organizations. They just have different titles. Statement of financial position is really your balance sheet, shows your assets, your liabilities, and your net assets. If you're a business person in the for-profit world, you would know that as equity, net assets or equity. You have a statement of activities, which is the same as a profit and loss or income statement, basically showing the revenue and income coming in, the expenses going out, and then the change in them. You would end up as a net income or a net loss for a for-profit business. For a nonprofit, it's a change in net assets, right? So net assets is equity. Statement of functional expenses is different. That's new for a nonprofit, new in that it's not something required for for-profit entities. And that breaks down your different expenses by functional category, functions being how much is spent in your programs, your administration, and your fundraising, this pairs well with the 990 conversation that Tanya just walked us through, because this is regurgitated there in the 990 because it's an important metric. We'll talk about that. Statement of cash flows is the same for a nonprofit and a for-profit. Shows you sources and uses of cash by three major categories, sometimes four, but usually just three: operating, investing, and financing. So what are the sources and uses of cash and cash equivalents during the period under audit or review in those different categories? And then there's the black and white wordy part, the notes, disclosures, or the footnotes, which usually accompany an audit or review financial statement that someone like us would prepare and look at for you. It's not usually available from an internal perspective, but these provide much more detail into the organization, its tax status, what it does, how it earns its fees, where it spends its money, major leases, major commitments, major contingencies, things like that are all spelled out in those footnotes. So these are some of the key accounting and auditing concepts that you should understand. So organizations, when they reach a certain size, and in the state of New York, it's generally when you're over $1 million in annual revenue or support, you need to be subjected to an audit by folks like us. We come in, we make sure that the books and records are accurate. They're presented in accordance with US generally accepted accounting principles. That's what's in this first point here. And you want to look for that unmodified opinion. We would call that a clean opinion, basically stating that the financial statements that we audited are accurate. They are what they should be. That's very important to note. So when you're getting a presentation from an auditor, you want to make sure you understand that the opinion was clean. 99 times out of 100, it should be, unless there's something really funky going on there. GAAP, we love acronyms in the accounting world. GAAP is generally accepted accounting principles. It's basically the accounting standards that are in force in the United States of America. So you'll hear references to GAAP. You'll see it all over the place, especially when accountants and CPAs are talking. That's all that means. It just means it's US accounting regulations being followed in the financial statements. The GAAP basis is an accrual basis, right? So you're recognizing revenue when earned and expenses when incurred, not necessarily when they're received in cash or paid for in cash, respectively. So that's an important distinction. A lot of organizations use the cash basis for internal purposes, for budgeting purposes, because they're most concerned with operations and cash flow and not these weird accounting concepts that don't affect the bottom line so much. But the GAAP basis financial statements will always be accrual basis accounting. And then net assets, I mentioned this is akin to equity for a for-profit company, but for a nonprofit, you have to present your net assets into those that are with and without donor restrictions. If you have endowments, there's other long acronyms that come into play, you know, the Prudent Management of Institutional Funds Act for the state, New York State, and for the US, that's with the uniform. So this is a little quirky and different. So net assets can be restricted for specific purposes. They can be restricted for certain time periods. They could be not restricted. The board may designate but not restrict net assets too. So all of this will appear in your statement of financial position, your statement of activities, and the footnotes describing what these different restrictions may or may not be for an organization. So you should be familiar with that too. And I'll explain why. This is just an overview here. Keep in mind the timeliness. So as auditors, we want to get in and get out as quickly as possible, but really we're beholden to the schedule that our clients force us into, right? So right now it's October. We're working on June 30 year ends. We should be in the midst of working on them, finishing them up. If our audits there haven't started yet, it's because a client typically isn't ready. If an audit is lingering on for a very long period of time, you should understand why that's happening too. Could be a preparedness issue. It could be errors and things like that that are causing delays. Could be the auditors are causing delays. It's a whole smattering of things. So when you're getting information that's audited or reviewed by CPAs at your board meetings, which you'll document in your minutes, you want to understand the timeline. You know, when are you being spoken to? When are you being presented to? Is it timely? Is it relevant information? Sometimes we're presenting a year after year end, and we have to, it's a requirement, but the information is very stale and may not be overly important anymore, right? Because it's 10, 11, 12 months old. Who really cares at that point? You know, we've already moved on to a new year. So you want to make sure things are as timely as possible. And if they're not, understand why. As a board member, you only have so much control over that, right? But management does, and you want to make sure that management is doing the right thing, preparing itself for its year-end audits, more importantly than that, just preparing accurate, timely financial information on an ongoing basis. And if there's delays in the audits, chances are they're not necessarily doing that. So timing is important. So we want to point out certain financial analyses and trends that you can do at the board level, or even at the management level, or both. So there's a whole listing here that we're going to try to go through and get through each one. I have 25 minutes to do it, so I'll try to speak quickly. We'll just flip straight to the next page. We start with certain liquidity measures. Liquidity is meant to show the ability of the organization to meet its financial obligations and liabilities as they come due in the next 12 months. So it's a very short-term measure of financial strength. If you look at the balance sheet of the statement of financial position, it includes a lot of long-term things, fixed assets, right? Property and equipment, maybe some restricted investments that you can't touch or use for operations. You may have long-term mortgages or other debts that are being paid over 10 to 30 years, something like that. I mean, that's important, but really what's most relevant for the here and now when we're meeting on a monthly or quarterly or annual basis with your board and your management team is how are we looking now and how are we looking for the next 12 months? You tend to budget on a 12-month basis. You should understand what your liquidity is. So there's current ratios, which are your current assets divided by your current liabilities. Current ratio should be at least 1.5 to 1. At least 1 to 1 to mean you can get through the next year, but 1 to 5, 1.5 shows that you're a good, healthy organization. You want to have positive working capital. What these words mean, working capital is the difference between your current assets and your current liabilities. Current assets are those that become cash within a year. It's your cash itself. Any short-term investments that you can use for operations. Receivables are generally collected within a year. They have some prepaid items and things like that. So it compares your current assets, those I just mentioned, to your current liabilities. That's the liabilities that are paid in the next 12 months or extinguished in the next 12 months. That's your vendor payables, any accruals that you may have there. You may have deferred income that you're going to earn over time as you provide services. You may have short-term maturities on debt. You may have lines of credit, lease obligations, things like that. So you want to have positive working capital, meaning your current assets are higher than your current liabilities. Obviously, right? That means you can get through the next year and pay your bills. That's important. The 1.5 to 1 gives you a little bit of a cushion there. Current ratios of less than 1 to 1 and negative working capital are worrisome signs, should spark questions to your management team and anyone else involved with finance there to say, how did we get in this situation? How do we get out of this situation? How do we look for next year? How are we going to meet these obligations as they come due? Does that mean we have to go further into long-term debt? Does it mean we have contributions coming in after year end that aren't reflected in the financial statements? Things like that have to be factored in. But you know, the indicators there are positive working capital, current ratios of 1 to 1 at least. Quick ratio is another liquidity measure. It's even stricter in that it just compares your cash, your receivables, your investments to current liabilities. So it carves out other current assets that aren't so cash flow driven. Again, 1 to 1 is the number you want to look for there. And also to reiterate, things do look low here. You want to understand why, how you got there, and how you're going to fix that and get better going forward. Days in cash is another useful metric. We like to calculate how much on average you spend on a daily basis in your organization. That's a daily cash burn rate. So really just take your total cash expenses divided by 365, and that tends to be what you spend. Obviously, that assumes consistency, right? If you had a major spend in a certain year that won't repeat in the next year, maybe you want to look at what you project those expenses to be and modify your cash burn rate. But you take whatever that burn rate is and put it under your cash balances to see how many days of operations your cash can support. It's hypothetical. It assumes no more dollars are coming into the organization, but it is a useful metric, especially when you benchmark it over time to see how your cash is in relation to the size of your operation, right? Obviously, the bigger the number, the better, generally speaking, but you don't want to have so much cash that it's just idle and you're not using it for anything, right? So you want to have at least, we're saying 60 to 90 days usually in cash on hand. That's 2 to 3 months. A lot of organizations have trouble collecting on receivables, especially if they're government funded, if they're working in the city or certain counties here in Long Island that like to delay you for all sorts of ridiculous reasons. You want to make sure you have a cash cushion on hand to sort of sustain you there. Lines of credit serve the same purpose, but they're hard to come by. A lot of banks are not friendly, generally speaking, to nonprofit organizations. It's not an area that they're comfortable working in. So a lot of nonprofits are left scrambling for cash a lot of times. You want to make sure you're keeping the lights on, you're paying your vendors. Most importantly, you're paying your employees every couple of weeks as that comes due. So take a look at that calculation, see how you are there. see how you've been trending over time. And if you seem low, find out why. If you seem very high, maybe the question is, should we be investing some of this cash? Do we need so much idle cash sitting around not earning high yields, right? Because interest rates are coming down. They were okay for a couple of years in terms of investment income, but maybe there's other investments you should put idle cash into. So it's just something that you need to look at. And obviously, it's hard to paint every nonprofit with the same brush. You're all very different. You're funded differently. So when I'm saying 60 to 90, it can be higher or lower depending on the type of organization you are and how you're funded. Days in receivables, I mentioned receivables a couple times. Receivables, accounts receivable, grants receivable, pledges receivable. The word receivable means you will receive it in the future. It's cash that will come into you for services provided already or for pledges that you've earned, that you've been made aware of. It's money that's coming to you in the future time, that's been committed to you, that's sitting as an asset on your books, but it's not cash yet. So how many days of receivables means how many days of your operations are kind of sitting in receivables waiting to be collected. The lower the number, the better. That means you're getting cash in faster. If it's a high number, it means it's taking longer to bring cash in. And cash is obviously better than receivables. You can pay your bills with cash, you really can't with receivables, right? So your main sources of funding determine what's an appropriate number of days in cash. I mentioned government-funded agencies. They tend to have higher days if they're contract-based. It may take 2, 3, 4, upwards of 6 months to a year sometimes to collect when you're claiming reimbursement to these different entities that are providing funds to you. If you're a Medicaid funded organization, it can be faster. But again, that's important to look at because maybe your billing department is slow in getting bills out. Maybe it has errors in billing, and that's resulting in denials, and future claims have to be made to reclaim for dollars. And there's so many things that go into what your days and receivables are or is and should be. But it's important to look at this over time, trend it against yourself, see if there's any fluctuations you're seeing there. You'd love to see 45 to 60 days. That means it's a regular collection cycle, but for a lot of you, that's just going to be virtually impossible. So you want to benchmark yourself here to see how you're doing over time and ask management appropriate questions of why you're whatever you are, getting better, getting worse. Is there anything you can do to appeal to government agencies and local representatives, maybe to enhance the collection process so you're not waiting so much? That tends to be the issue more than anything, is when you're very heavily state funded, sometimes local county funded, certain agencies within the local governments, they are just notorious for seemingly playing games with you, right? Requesting bud mods, denying things, just not responding. So board members can get involved with that. Your CFOs, your CEOs, your executive directors, they can only get so far when there's a consistent message from a bunch of different people reaching out and saying, listen, you're really hampering our ability as a nonprofit to do the work we're supposed to do because you're not paying us or you're playing games with our claims. You tend to get better results that way. So that's something that definitely board members should understand and get involved with. Debt to assets, it's a calculation that measures your leverage, right? Generally speaking, you want less debt, but sometimes you may be in a capital intensive type of nonprofit industry, like affordable housing or something like that, where you acquire properties and you want to use debt financing to do that because you don't have the dollars lying around because you can't raise that much money. So you just want to make sure that your debt is never becoming too much of a burden to your overall operation, that you can afford the interest expense. And a good way to look at that is to really just calculate your debt as a percent of your total assets. Ratio of 1.25 to 1 is considered acceptable in terms of assets to debts. 25% is what that should say. 25% of your total assets being debts. But that number can go up or down depending on the type of organization you are, what your appetite is, and how much other discretionary income you have coming in that can relieve that debt over time, principal and interest. But to calculate that, you need to factor in your lines of credit, any mortgages that may be out there, other promissory notes, related party notes, equipment loans, things like that. Just put that number over your total assets and see where that comes out. And again, trend it out over time. That's very important. A number all by itself, isolated in a vacuum, isn't all that meaningful. But when you look at yourself over time, you can see if things are getting higher or lower, better or worse. That's when you have pointed questions to ask of management to really understand what's happening in the nonprofit, in the business that you're running as a nonprofit, to generate these numbers, and if they mean anything, if they're warning signs or if they're innocuous, and you can just move on. Net assets is important. Nonprofit organizations, it's a bit of a misnomer, right? Nonprofit. really the proper label is tax exempt, right? You don't pay income taxes because of the mission that you have, because everything you're doing is in furtherance of that higher purpose. You can make a profit, just don't pay tax on it. So a profit is not a term you'll see in financial statements for a nonprofit organization. It would be like a change in net assets. So you want to see that net assets are at least not dwindling away. You don't want to see consistent losses, right? Even though you're a nonprofit, you can show that positive net income, so to speak. So you want to see a slow increase over time, at least, or steadiness, or things remaining consistent. Again, organizations are all different shapes and sizes here. Some have major endowments and they operate on losses, and that's okay. You know you have the financial power behind you and you can afford those losses over time. That could be purposeful. Most organizations don't have that luxury. They have to really operate on a budget basis, get through each year, put away money in reserves and things like that. So you want to see that steady increase in net assets. If depreciation is significant, you may want to sort of add that back. That's a non-cash expense. I won't get too into the weeds with that, but just know if you're capital intensive, you have a lot of property and equipment, and you have major depreciation, your net assets may be a little bit misleading because property and equipment are stated at historical cost, depreciated over time. Real estate generally appreciates in value, especially where we seem to be located in the New York area. You know, there's ups and downs, but usually it's a higher trend. So you may have a declining value on your books, but it's actually worth more in reality. And that's not shown because US GAAP doesn't account for property and equipment that way. It's based on cost if it's used in operations. You also want to look at expendable net assets. This is important for that type of organization. You may be an organization with a high level of net assets as a dollar term, but it might be tied up in long-term assets that you can't use to do anything with, such as your property and equipment. So if you have a major balance in property and equipment and you have offsetting debt and things like that, you may want to add them back, take them out of the calculation when you're looking at your net assets to see really what's there that can pay the bills and keep the lights on. That's important to note too. Accounts receivable are counted in determining debt to asset. Yes, because they're an asset. They'd be part of the denominator there. Program trends are important. It's a significant measurement of the organization's operating effectiveness. Your programs want to sort of operate in a profitable or break-even sense, right? Again, you're a nonprofit, but you're a business. You have to keep things afloat. Can't be losing money on programs year after year after year. So something that we see a lot is program revenue less direct program expenses by funding source to see how you're doing there. We do see some organizations go back to government agencies and say, hey, we need more money because we're operating at such a significant loss and we can't always subsidize that with everything else we're doing. A lot of deficit funded contracts from government agencies don't pay a lot of admin costs and you wind up underwater on them. And the hope is that you have contributions, fundraising income, something else that can pay for it, but sometimes you don't. And then it becomes a sort of losing battle. And sometimes you have to make hard decisions about cutting programs that you can't make money on if they're jeopardizing the existence of the entire organization and your other programs. So that's something to keep in mind there. If you're having declines in net assets year after year, chances are that some program or programs you're running that are not profitable, you should dig a little deeper to understand what they are, why that's happening, if you can do anything about it, and if not, if you have to make that hard decision to cut. You also want to look for concentrations of revenue. You don't want to be too reliant on any one funding source, as reliable as they may seem. Things change in the future, right? Leadership changes at those organizations or those government agencies. You don't want to be losing your entire really program, your entire mission if you lose your major funding source. So you want to diversify as much as possible. If you're a fee-for-service-based organization, you want to look at trends in units of service. How many people are you serving? How many meals are you serving? And all those types of things, and trend that out over time and see if there's any relationship there that you can look at. Revenue or expense per unit of service is important for those type of organizations. You might see that there's a huge demand, but the rates are getting paid or going down over time, which probably leads to losses. So there's always a lot of digging that can take place when you have these types of funding arrangements. Fundraising events, you want to make sure they're profitable, right? Yes, we can have a copy of these slides. Susan, that'll be sent out. I think it's already in the chat, but we can add that. But fundraising profitability is important. You don't want to have fundraising events if you're not at least breaking even. What's the point? I mean, I guess it's good to get your name out there in hopes of future contributions from having your brand more visible. But generally speaking, fundraising events are a major labor of love and a major cost center. So you want to make sure we recommend a profit ratio of 3 to 1, 3 to 1 income to expense. 2 to 1 is okay and acceptable, but if you're doing a really good job, you're going to be at that 3 to 1 level. That's going to generate income for your operations. It should usually be discretionary, where it's not tied up and has to be spent on certain things. So you should look at that as a whole in and of itself, but also looking for trends. See if your fundraising events are as profitable as they were in the past. If not, why? If they are, that's great. And if you can do better, ask those questions too. Program service percentage is very important. It always has been, it always will be. This is all publicly available in your 990. Basically, it's what percent of your total expenditures are going to your mission and your exempt purpose. So it's easy to calculate. Program expenses divided by total expenses. The higher the percentage, generally speaking, the better. But again, context is important. Not all organizations can have such great high program service expenses. Generally speaking, when you're very small and new and volunteer-based, you can have a higher one because your expenses are just lower. And when you're much larger, multi $10 million plus organization and up, they get economies of scale where they have a certain level of fixed costs that are taken care of, and any new income revenue they bring in and expenditures they make don't really affect that. They don't increase that. Those are the ones in the 90 percentile. Most organizations we like to see at least in the 70s, 75% and up, I think is good. It just feels to me, and this isn't a judgment on my part, it's just an observation, that when your program service percentage is in the 60s or lower, it just seems that donors and others react less favorably to that, let's say. Doesn't mean your tax exempt status is in jeopardy or anything like that. But in terms of donors looking to give dollars to organizations, they want to see that number, I think, at least to start with a 7 and go up from there. 80s, 90s, even better. So take a look at that, understand, one, how you're allocating these costs and if that's accurate, because oftentimes we find that it's not, and there's an artificially low number that's being reported to everybody out there. So you want to make sure the number's right. And once it's right, you want to make sure you're maximizing it and getting it as high as you possibly can, as long as you're running the business the right way. So now in terms of the budget process, we're coming down to the end here. Budgeting is obviously very important. It's something that boards do get involved with. And how do they get involved is often the question, because sometimes you're just presented with numbers and you're looking to have management, sort of buy in on what they're doing, but you want to make sure you understand what's going on. So you want to ensure stakeholder involvement, confirm that staff leadership and committees are all involved in the budget development to enhance accuracy and buy-in. You want to make sure internal departments at the staff level are having input. You want to make sure different committees on the board, if you have that, are involved, especially obviously the finance committee. You want to make sure that everybody is involved, everyone's on the same page, everyone's voting to approve the budget the way that it's presented. You want to review those assumptions in the budget very thoroughly, understand the rationales behind revenue projections, expense estimates, and the funding sources to ensure they're realistic and mission aligned. Obviously, things change. You can only budget so much. You should do budget to actual reporting, which is in here too, to make sure that, if there are changes to what's going on in reality versus budget, you understand why and what you can do about it. You want to ensure strategic alignment, confirm that the budget reflects the organization's goals, priorities, and programmatic plans. It's not just finance driven, right? Remember, you're a nonprofit organization. What are you trying to accomplish at the end of the day in terms of your program, in terms of your missions, and what you're trying to achieve? That should also be paired with the finances to make sure that both are being factored into that. Participation in the budget development is important. Engage early in the cycle to provide input, ask questions as a board member, and help shape priorities before the final approval. So make sure you're involved, ask questions. Things don't make sense to you, understand why, and be a good, useful sounding board for management as they're preparing these for you. Understanding revenue streams and restrictions is very important. Sources of income are very different for the nonprofit world. Some you can only be break even, where you're getting reimbursed for what you're spending. Others you can make profits on. Some contributions may seem great, but they may be so tied up that you can't use them on anything except for very specific restricted purposes, to go back to what I started saying earlier. So really you have to understand the revenue streams, because that drives everything in the budget. Where the money's coming from will dictate how the money is going to be spent. It flows right down to assessing the expense categories for efficiency. Staffing programs, fundraising, you want to see that things seem cost effective. You don't want to have budgeting major losses. If you have actual losses year after year, you want to understand why and how you can maybe adjust the budget to avoid that going further. Contingency budgets is something we don't see a lot of, but I think it's important. Especially for certain organizations where the revenue is a little bit more volatile and variable. right? You should be modeling out what happens if this funding source dries up? What happens if we don't meet our contribution objectives? Where are we going to take that out on the other side, the expense side of things? Prepare for that in advance so that you know as the year is unfolding what you have to do to respond to that, so you're not taken off guard. Support transparency and accountability, promote clear documentation of budget decisions. This goes back to what Tanya was saying about the board meeting minutes. Document it thoroughly, engage open discussion about it, encourage open discussion about it, ensure the board formally approves the final budget. Budget to actual performance. It should be on a monthly, quarterly basis, whatever. Your internal accounting team should be preparing reports, comparing the actual performance for that period of time to the budgeted, and you should understand why there's variances and what that means for the organization. Again, you're looking for red flags. You're looking to understand what's happening. What can you do better to adjust for this? And that's something that really doesn't happen all that often, that we think should be done a lot more often. The second block of text there, what doesn't often get included in budgets is any capital needs. So a lot of organizations don't have this issue, but some do. They're capital intensive, like I said a few times. Do you have aging assets? Do you need roofs that'll be replaced, or windows or something like that in the future? And if so, where is that money coming from? Because it's not usually budgeted for. It's not usually included in a government grant contract or something like that. May result in capital campaigns and other endeavors to try to bring the dollars in to pay for these things. But that has to be factored into. It can't just be looking at the typical revenue and expense, because there are other needs for cash flows, whether it's pay downs of debt, whether it's capital expenditures, investing in new technology, something like that. All these different things cost money and are not always well planned out. So plan out for them, and you'll be sure to handle them more appropriately than if you didn't. In terms of strengthening board engagement in finances and risk management, that's what we're here to talk about, right? We're accountants, so we're not really qualified enough to talk about anything but the finances, risk management part of that. So regular financial training, I think, is important. I started this by saying board members are not often well-versed in financial topics because that's not their background. It's not their fault, but they can learn and they should be taught.